Stocks trade in a range ahead of a likely India-US trade deal announcement. FMCG and crude oil users gain, while metals and industrials drag.
India and US are close to striking a mini trade deal in the next 48 hours. Negotiations on the pact are mostly complete and offer a fair deal for India's labor-intensive sectors, with some concessions for select US agri products and pencil in an average tariff rate of 10%.
IndusInd Bank sees a dip in both advances and deposits in the first quarter, but retail deposits remain mostly steady quarter on quarter, suggesting customer confidence in the bank. Analysts, however, remain divided on the stock.
Godrej Consumer, Dabur and Nykaa point to consumption ticking up. Jewelry makers Kalyan and Senco post strong Q1 growth, and QSR major Jubilant Foodworks clocks healthy pizza sales.
Defense Secretary R.K. Singh says India will up its defense spend to 2.5% of GDP from the current 1.9% in the next 5-year plan. Starting FY26, he adds that the contract for fifth-generation jets will be awarded in the next 3 to 6 months, even as developing a fifth-gen jet and taking it to the skies can take 10 years. The management of HAL confirms the same. You're watching us here on Halftime Report. Good afternoon. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ekta Batra. If you look at the markets today, just the frontline indices, you would not be, mistaken if you said that there's no move which is taking place. But beneath the surface is where a lot of action is, underway. Most specifically in the consumer space, we do have, the FMCG stocks which are buzzing around in today's trading session. We got a slew of updates that came in over the weekend, and that suggests that maybe the consumer sentiment is improving. And not only are the related stocks moving around, but we have HUL, which is the top Nifty gainer right now after nearly 5 years of doing nothing. The street believes that maybe the worst of consumer sentiment is behind, and perhaps these are priced in. How this moves along from here is something that we'll discuss through the course of the show. We'll talk about these updates, and we'll probably get in an analyst and an expert to join in as well. But a bunch of stocks in focus, Ekta.
Hi, Mangalam. Yes, absolutely. We do have a bunch of stocks which are in focus, but really it's the market which is completely in wait and watch mode amidst the tariff deadline uncertainty at this point in time. But separately, we do have the Q1 updates to reckon with at this point in time. And remember that it is an indication that earnings are kicking off this week itself. We have TCS on Thursday, and then stocks such as DMart, which will be releasing its numbers on the 11th of July as well. So we have an action-packed couple of weeks coming up, and maybe a couple of, maybe the next 24 to 48 hours when it comes to any kind of developments when it comes to tariffs. But nonetheless, let's kick off the show with a couple of stocks. Borosil Renewables, the German arm, has filed for bankruptcy due to demand paucity and depleted market conditions since January. Vivek is here to tell us about this interesting story. Vivek, over to you.
Well, that's right. Over the last couple of years, similar to what was happening in the Indian solar glass manufacturing market, demand in Europe has been muted, and also the solar glass industry itself, while end-user demand has been quite robust, the demand for the solar glass that Borosil manufactures has been muted, mainly due to the back of the fact that Chinese players have been dumping, large quantities of that particular solar glass that Borosil manufactures at much lower rates. So there has been significant dumping that Borosil has witnessed over the past couple of years, especially as far as the German operations are concerned. So taking this into account, in January, the company had pulled down the furnace, so operations weren't going on anymore. And now GMP has taken a decisive action to file for bankruptcy. Now, why is this material? Why is this important? FY25, 22% of total consolidated top line came in from this particular operations, and it was EBITDA as well as PAT loss making. Now, what is the company saying? The company was saying that in terms of financial, total exposure was close to 350 crore. On a monthly basis, the company was incurring excesses of close to 9 crores, which now immediately stops. And earlier today, we also had the management. So the management said, in terms of exposure, there are no third-party exposures. All of the debts are from the parent Borosil Renewable only to the extent of 350 crores. Indian operations are doing quite well, and in fact, the company said EBITDA margins are expected to inch up higher, and also 27 crore on account of the monthly loss being arrested is something that can be added to the bottom line. So overall, on the back of the loss being arrested, Borosil Renewables is doing quite well.
Take that point entirely, Vivek, and plus the cycle is moving as well. That's what the management has been telling us for the last few quarters. In fact, this morning itself, the management joined in Mr. Srivar Kheruka, and this is what they had to say on this matter.
The government probably needs some time to wrap its head around how they want to restructure the solar manufacturing in Germany. At this time, there's an interim administrator who's been appointed, and he'll make a report, and then he's going to go back with his recommendations, which might take about 3 months. Our exposure is 35 million euros altogether. We have funded about 20 out of this was 27 million was funded by us. So the exposure is not something which I can speak about now, because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. Margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country, and we continue to meet the demands of our customers. So we're looking at a 60% expansion, and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. The revenue has gone, but the profits have gone up. To the extent maybe nearly 27 crores per quarter is going to rise.
Okay, all right. Well, on that note, we need to take a short break. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. Well, for the markets, there's a little bit of pressure that we are seeing incrementally at this point. So the mid-cap index is down around 0.2%. We have the Nifty, which is just about lower by around 30-odd points. So nothing really to write home about. And the Bank Nifty also, which has lost over 130-odd points. If you are talking about specific stocks, Mangalam did mention HUL, which is your top gainer on the Nifty. But if you're talking about top losers, it's TechM from the IT space, which is losing out. So that stock is down around 1.8%. A couple of the cement stocks are under pressure as well. So Ultratech Cement, Shree Cement, both those stocks are showing a cut of around anywhere between 1% to almost 2% for a couple of these. So that's what's taking place in the markets. Quiet at this point in time, just about in wait and watch and consolidation mode. So what are the F&O cues throwing up? Mangalam, tell us more.
Well, not too different from the fact that there is still some consolidation. The frontline indices are consolidating. We've seen rallies from lower levels of 25,330 thereabouts that we saw in the previous trading session on Friday. And we've also seen sell-offs from levels upwards of 25,670 thereabouts, which was, again, the high that we saw in the week prior to the previous week. So that's really the broad range, 25,350 to roughly 25,650. And the market has been meandering between these ranges itself. The frontline index down by about 0.1%, the Nifty Bank down by about 0.25%, the mid-cap index as well lower by about 0.25%, but no such problems for the FMCG space. Over the last few days, we've seen one IT day, we've seen one, Nifty Bank day, we've seen a lot of the cement days and power days as well. But today's day definitely belongs to FMCG on the back of good updates that have come in from the likes of Godrej and Dabur. HUL, the leader of the pack, has no update, but is taking a note of all these others which have reported the numbers. And similar is the kind of case that we're seeing for names like Colgate, Tata Consumer Products, as well as Britannia as well. We had Varun Berry join us a week ago and say that they're not too far away from double-digit growth for the entire sector. And all of this is playing out right now. But for the frontline index, consolidation continues. We have 25,400 put, which is fairly active in today's trading session, as is the 25,450 put. What's the premium of the 25,400 put? 95 rupees. Pull up the 25,450 put, you have a premium of almost 108 rupees, telling you between 25,300 and 25,350 is a strong amount of support. In fact, that's something that we've seen play out in the previous trading session as well. But around 25,600, we will see some supply. That's the story that is visible from the 25,500 call, which has a premium of 94 rupees. Apart from, the FMCG stocks, a lot of stocks, other stocks in focus belong to the capital markets play. IIFL Finance, which was lower in trade in the previous trading session on account of the decline that we saw on capital market plays, because Jane Street is now bouncing back smartly and currently seeing a lot of long positions being built up as well. But we are seeing some shorts build up on InfoEdge as well as Jubilant FoodWorks. Remember, Jubilant FoodWorks reported a good update for the first quarter, but valuations over 75 times, not giving enough room for an up move on that stock, explains why we are seeing some short build up despite a good update.
Okay, all right, Mangalam, thanks very much for that. We do now have Manish Hathiramani joining in to discuss the technicals of the market. Manish, hi, welcome to the show. It's a quiet day, lot of consolidation in today's trade. What's your strategy for the Nifty?
Good afternoon to you and to all our viewers. Thank you so much for having me on the show. Well, I feel Nifty is still a little sideways because 25,600 to 25,700 was a resistance point, which we achieved. So the index is still trying to decide on the next course of action. While the structural bias still remains on the upside, it might take a few sessions for us to understand the direction of the Nifty. If the index moves up from here, we should be looking at 25,850 to 25,900 as a target. A very good support lies around 25,300.
All right, 25,300 to 25,700 is the broad range. Manish, individual stocks, what are you liking right now?
I'm working with two buy calls. My first one is on Reliance Industries, which is for a target of 1,600, stop loss 1,475. The stock has been in a steady uptrend, and we have also crossed the highs of 30th August and 27th September from last year. These have happened on the back of healthy volumes. The second one is on a BPCL, target 370, stop loss 330. The last 3-4 sessions have seen good volumes. Apart from that, the stock has also gone past its recent high very easily, therefore signaling a positive structure.
If you're positive on Reliance, then is your long-term view on the Nifty also on the positive side? Because if the Reliance stock has to go at 1,600, go to 1,600 right now, it would take the Nifty to around 25,600, 25,700. Thereafter, what's your call?
Definitely, Mangalam. I still feel the structural bias on the Nifty is on the upside. As a trader, we would only like to get into the chart, get into a trade only when we have a proper directional breakout. Having said that, if we can get past these levels, 25,900 is a target that I would work with.
Okay, all right, Manish. Well, on that note, we need to take a short break with the news that the markets are still under pressure. We'll come back. But up next, we have an interesting discussion. We have Abneesh Roy, the Executive Director at Nuvama Institutional Equities, who join in to discuss the Q1 FY26 business updates of all of the FMCG stocks. Stay tuned.
Consumer stocks, they are in focus right now. Godrej Consumers moved to the high point of trade, up 6% right now. Even Dabur is doing extremely well, 4% higher. And on the back of that, we are seeing some traction in HUL. We are seeing some traction in Colgate. All the stocks actually doing a lot better. We do have Abneesh Roy of Nuvama joining in. Abneesh, the updates do suggest that the worst of demand is behind all these companies. What we want to understand is that these stocks which have been underperforming in the past, can they return to their glory days just basis this update coming in? Yes, there is a relief rally that we're seeing in a lot of these stocks, but the underlying problems, not all of them have gone away, right? While there is some sequential recovery, margins are still not back to their all-time highs. Companies are believing that there could be some improvement in the second half of this year. What are your thoughts on this entire space and the updates that have come in over the weekend? Anything that you liked in particular?
Sure, thanks and good afternoon. Yes, we were expecting stocks to do quite well, and we expect that the recovery in terms of urban will soon start. In some categories, it has started. So 4 key things. There is high under ownership in the sector. If you see the FI selling numbers which have come last 2 months, there's been a lot of FI selling in the FMCG sector. And if you see the business update, they are telling a different side of the story. So Marico, in our view, we don't rule out 9% volume growth in the Q1 for the domestic part of the business versus 7%, I think, which the consensus was expecting. Again, same thing, Godrej Consumer, HI saw a spectacular recovery in the June month versus earlier expectation of 2 to 3% India volume growth. They will end at around 4 to 5%. Even Hindustan Unilever, we expect that it will positively surprise versus the muted expectation, which I think most part of the consensus has. And the fund managers also from a HUL perspective have a very muted expectation. We expect that maybe 4 to 5% sales growth for HUL is highly possible in Q1. So we are seeing the raw material side also play out. So you asked the right question whether margins will improve. Yeah, in food companies, it will start improving. So Britannia, BKG, to an extent Nestle, etc. For Godrej Consumer and HUL, our sense is exit part of the Q2, we will see the recovery because there's a lag of PFAD versus palm oil. Coffee cost has also corrected. So except one or two like copra and maybe tea, most other commodities are under control. So valuation clearly favorable, under ownership, recovery from macro perspective. HUL in the AGM highlighted that a lot of the macro is now falling in place. I will expect the sector to do well, and consensus upgrades are also possible. For someone like a Dabur, I think still they need an answer to Campa Cola and overall Chyawanprash, how to contemporize the product to the youth. I think that's needed. But in most parts of other where non-summer is there, we are positive. Summer portfolio clearly will see challenges. So Varun Beverages, Imami, etc. will see weak numbers in Q1, but that's because of the season.
Okay. Well, Abneesh, Godrej Consumer is reacting very well to its Q1 update. What did you think of it and the fact that they've said that volume growth has been strongly competitive and they expect it to sequentially improve?
Yes, so 2-3 things the consensus liked on Godrej Consumer. So this is the second successive quarter where the slightly challenging category of household insecticide has seen a good number. So last quarter was, Q4 was 15% sales growth in HI in India. This quarter, again, mid to high single digit, and that's not a bad number after a very weak May month. So May month was very challenging. June month saw spectacular recovery. Second, of course, the Guam part of the business, so Africa, etc., that has seen a strong double-digit volume and sales growth. So that's a key positive. Third, of course, outlook from a margin perspective, clearly worst is behind. Q2 still will be under pressure more because of the lag effect. Otherwise, if you see palm oil and PFAD are correlated, there is some lag. So in H2, we'll see very smart recovery in the margins. So investors are getting a comfort that yes, Indonesia is challenging for the next 1 year, but that's a very small part of the business, right? Ultimately, India and Guam are bulk of the business. And there we are seeing that numbers are improving both on the volumes and from a margin outlook, we'll see recovery, strong recovery in the margins in H2 for GCPL.
All right. I wanted your thoughts in particular on the consumer discretionary side. Now, it's not that we got any weak numbers from Jubilant FoodWorks. It was extremely strong, the second or third quarter of double-digit like-for-like growth. Even Nykaa, no problems out there. At the same time, Kalyan Jewellers as well reported a very strong growth at 31%. But all these stocks have been outperformers in the past and are now selling off on the back of good numbers. And which is why my first question to you, is it only because of under-ownership and underperformance that these stocks are rising? Can this outperformance sustain? Because in the case of discretionary, they aren't sustaining. At some point, valuations kick in and we see profit booking. Case in point, Jubilant FoodWorks down 4% right now from the highs.
Yeah, in any stock, I think there will be multiple things to watch out. But yes, broader theme, what we see is staples under-ownership is there. Plus rural, whatever can go right in terms of good monsoon, government having a more liberal exports policy, a lot of freebies being given by every state government, etc. That obviously the discretionary companies have a much lesser play in that. So that is one more thing. Yes, from a raw material side, again, if you see the FMCG companies will have more headroom to retain that. In QSR also, maybe there'll be some benefit here and there in terms of the margins in the second half from a lower dairy cost, etc. But overall, FMCG margins clearly from a palm oil perspective, from a lower coffee cost from the Q2 perspective, or even in paint companies, if you see, we see that gross margin should improve this year and EBITDA margin also mostly. We see that the margin trajectory is much more predictable and on the upswing for the FMCG rather than discretionary. And discretionary stocks, you rightly said, last 1 year, 2 years, they have done much more better. While FMCG last 3-4 years, many stocks like HUL, Dabur, Asian Paint have
Got
not
it.
given any kind of wealth generation. So that's the catch up,
So
which is also helping.
staples over discretionary is the big call right now. On retail, I wanted your thoughts also, because we did get the update from Avenue Supermart. 16%, one wouldn't say is very bad, but the stock saw a bit of a sell-off post that. Trent was the big underperformer, 20% growth only versus 25% that the company itself had guided. And we saw a reaction on the stock on the downside, 11% lower on Friday. What have you made of V-Mart, Avenue Supermarts, V2 Retail and Trent? And what's the trajectory for them likely to be going forward?
Yeah, absolutely. DMart, Avenue Supermart, good set of numbers, 16%, 17%, 1 quarter here, 2nd quarter. I think broadly it's in the same ballpark number. The opening store in Agra, I think that's a very key development because UP is India's largest population state. And if they're going beyond NCR, that clearly shows that UP over the next 3 to 5 years can become really, really big in terms of store addition. Store addition was also quite good for Avenue Supermart. So Avenue Supermart, overall, I'll say that should do well as a stock, medium term, long term. Of course, margins we need to see because the quick commerce continues to be an issue. But quarter on quarter, we see some recovery in the Avenue Supermart because of the seasonality. Coming to the gold jewelry companies, there most of the growth is coming essentially from 2 things. One is very high gold prices, and second is the store expansion. So that's why I think because stocks have done reasonably well, there is a question mark that if gold corrects, then what happens? So that is the small difference. So you will not have every stock react to the good numbers every quarter. Yeah, in terms of the apparel, clearly V-Mart had slightly impact of the shift of the season, right? Eid has shifted, and that's why my sense is some of the apparel companies will see that impact in some of the market. That doesn't mean that the entire year will see that impact. So it's more of a seasonal shift, festival shift in some of the apparel retailers, which is impacting them. Nykaa, frankly speaking, here the margin improvement is what investors are watching for. Of course, we had a block deal last week, which was slight supply overhang. But in their core business, I think they are doing reasonably well. Now investors are looking for overall console margin improvement, which I think once that happens, then the stock will lead it. Till then, I think overhang on the Nykaa is there from a margin perspective.
Okay. Well, Abneesh, what has really been in focus is the entire paint space. And interestingly, we had a brokerage which upgraded its call on Asian Paints as well as Berger recently after 4 years of a negative stance. So the fight for number 3 continues, and it's probably gotten even more difficult now. But your sense in terms of what the dynamics would be and how they would play out when it comes to earnings for these front-facing paint companies now?
Yeah, good question. Again, 3-4 things. First is here also we are seeing core paints. The volume recovery is there. If you see the second half of FY25, the core paints for the industry saw some decline, 1 or 2%. Don't measure this against the reported volume growth because the reported volume growth of Asian Paint and some of the paint companies also has non-paints like waterproofing, construction, chemical, which grow obviously much faster, putty, etc. So what we are picking up now, the core paint for the industry is seeing low single-digit volume growth. So clearly this mirrors with what HUL is seeing in terms of macro improvement leading to overall demand improvement. Marico reporting stronger volume growth. Godrej Consumer also reporting stronger volume growth. Dabur seeing mid to high single-digit volume growth X of summer in most categories. So it's again mirroring that. Paint, in our view, worst is behind on the demand side. Gradual recovery will happen. That also is reflective in terms of the very high promotional intensity which was there in the mid and premium end of paints. We are picking up that promotional intensity is now high largely in the lower end. When I say at the mid and premium, it is not as high. I am referring to the peak. From the peak, there is a correction. It's a lower intensity. Of course, consolidation has happened, and once the approval comes, Axo will not be there. It will be JSW. So yes, in this industry also, growth is coming back. Gross margin, no problem whatsoever. So we see Asian Paint deliver 18 to 20% EBITDA margin for the full year, FY26 versus 17.5%, I think, last year. So there is an improvement on EBITDA margins for the market leader. Sector, again, very under-owned. Again, Asian Paint stock performance last 4 years, there has been wealth destruction and not much. So I would say that again, Asian Paint, HUL over the next 1 year, if the demand recovery happens, good wealth generation will happen.
All right, take that point up, Nish. Thank you so much for that. So the big headline for today is the next 1 year belongs to staples over discretionary. The last 1 year, discretionary has done well. Now it's time for staples to shine after underperforming. Well, will they be supported by commodities or not? We have Manisha Gupta on the other side of this short break joining in. Bimal Kothari, the chairperson of IPGA, joins in on the Commodities Corner.
Welcome back, and joining us on the show now is Chairman of IPGA, Bimal Kothari. Mr. Kothari, thank you so much for joining in. First of all, your sense on the sowing numbers itself, which seems better than last year, but when you look deeper, when you look at each of those pulses, that is where the devil clearly appears. What has been your sense on that till time?
Thank you, Manisha, for inviting me. So far, I think it's too early to predict the numbers, but whatever the information we are getting, I think for mung beans we had a good crop of we had a good summer crop, and the kharif crop also looks good, and urad also is as of now it looks good. I mean, if you compare to the earlier years, I think we have a good showing so far. And tuar, of course, in Karnataka and some places we see that what we are getting that it might be down by 25%, but it is too early to predict the numbers now. There might be a little bit shortfall in tuar, but as I said, it is too early to, because the entire month of July is still, the window is open, so we can see the planting to grow, catch up. So I don't think this is a good time to talk about the numbers, but so far it is satisfactory, except tuar, where we have seen it. There is a little bit concern, but as I said, the window is still open, so we can still catch up.
Mr. Kothari, would you say concern is also to the point, because most of these pulses have been trading below MSP? Do you see a shift of area to other crops then?
Yeah, that we have seen. I mean, that is why I'm saying the crop of tuar looks a little low, because in MP and in Karnataka also, the information what we are getting, there is some shift to the crops. And this is what we have been telling, because the cheaper import is definitely hurting the farmers. And so that's why the farmer might be discouraged to plant these crops. So though the government has assured that they will buy the 100% of the crop, at least as far as the tuar and udar and lentils are concerned. But that is we have to see practically how far that is possible. But definitely this is a really big concern. Because if you look at the import prices, say for example, now during the kharif we have tuar, udad and mung. So tuar kharif prices, the MSP price is 80 rupees, whereas now the next month we will see the import taking place from Africa, and we understand they have a good substantial crop of about 1 million ton, and as of now the lending cost is around 50 rupees. So and whereas our MSP is 80 rupees. So definitely there is a concern, because the cheaper import will definitely suppress the prices domestically, and the farmer may they may like to then shift to the other crops which are more remunerative. So this is a concern which we have addressed to the government several times. I'm sure that the government will look into it, because the government's main concern is the inflation. But I understand now that the price of most of the pulses are below minimum support price. So the concern of the inflation has been fully taken care of. I think they should definitely look into the interests of farmers as well as the trade industry also.
Absolutely. Mr. Kothari, also, what's your sense really when it comes to imports from various other countries? Because yes, financial year 2025, we've seen record imports come in. But when I look at the data for April, May, even June for that matter, the imports have slightly come off. Is that a pattern that you see going forward as well?
Because we had a large import. In fact, it was a record import of 7.3 million tons during the last year. So we had a carryover stock from the imports. So that's why there has been the import has been little has come off. But you see, now the new crops are going to be harvested in the origins. For example, in Russia and Canada, the new crop of yellow peas is going to be harvested, and the prices are coming down. Already, in fact, we are getting the price of around $325 to $330 as against $385 to $400 last year during the same period. And also as I mentioned about the tuber crop is getting harvested in East Africa, so we'll see a good amount of tuber arrivals in the festival season, and price, I'm sure price will further go down. It's already, the African tuber is selling around 55 to 60 rupees in Indian market now, and I feel that this will go down to around 50 rupees.
50 as
If you look at the other pulses like lentils is also going to be harvested in August. So I see that in the coming months, and looking at the festival demand, and though we have enough stock in the with us, so I don't think we require a very large amount of imports. But because of the price parity and the origins are having very good crop, sure they will bring down the prices. And because India is the biggest market as far as the imports are concerned, so they will like to sell their crops into the Indian market. And also I will like to mention about the urad. There is a good crop of urad in Brazil also. They started just 2 years back from 5,000 tons, and we are expecting about 250,000 tons this year. So you see that all the origins, they are looking at the Indian market, and they are growing a lot of pulses. And also now, as our government is also striving to achieve the self-reliance, so our production also this year was good. And so that's why, we need to balance the import so that the cheaper import is not hurting our farmers. So we have advised the government of India several times, and again we will keep on harping on this issue that the government should balance the prices by imposing the dynamic duty. They should impose the duty that the lending cost of imported product is not less than the minimum support price.
Absolutely.
So that the minimum support price policy doesn't become irrelevant.
Okay, all right, Manisha. Thanks very much for taking us through that conversation. Just need to get back to the markets at this point. Well, it is still static, but we do have the advanced decline ratio, which is still on the declining side. So let's see whether that worsens as the day goes along. But just about wait and watch mode currently for the Nifty and the Sensex. We'll take a short break, but we'll get you a lot more in terms of specific stock action on the other side. Stay tuned.
Welcome back. Let's focus on the primary market action then. Smartworks co-working spaces will open its IPO on the 10th of July with a fresh issue of nearly 445 crore rupees. Nitish Sarda as well as Harsh Binani spoke to Reema Tendulkar about the IPO details, the company's strategy post-listing and whether they turn profitable or not.
We are technically profitable. Okay. The numbers that you see reflected on our financial statements are because of the accounting impact. Our adjusted EBITDA, in fact, grew by more than 3.5 times from about 36 crores to about 177 crores in FY25. So currently our net debt stands at about 310 crores.
Okay.
Post the IPO, we are also repaying close to about 114 crores of high cost debt. And the company is in fact going to turn net positive right after IPO. We will be net debt positive, so we will be debt free.
Debt free. And what about at the bottom line?
So our bottom line, just to give you a perspective, has actually grown by more than 3.5 times in the last 3 years. So the last year's numbers in FY25 was 176 crores. And technically, if we exclude the accounting impact.
So could you give us those numbers? Now I can see FY25 revenue, operating revenue was about 1374 crore rupees. Your EBITDA was about 857 crore rupees. And you come up with an EBITDA margins of 63% thereabout. Break it down for us line by line after this.
Absolutely. So once we take the about 850 crores that you just mentioned, the first adjustment that you would basically make is for the lease rentals that we end up paying, which is close to about 650 crores. Then you have the additional 40 crores that we pay as financing cost. The balance is the amount. Once that is adjusted, you derive the number of 177 crores.
Okay. So debt from 310 becomes
close to about 220-ish.
Okay.
But the
I'm
cash
still trying to
balances-
get the thing, right? At the bottom line, X of all the adjustments, what I can see on my P&L, when do you think you will turn profitable?
So while I will not comment on the exact timeline, what I can give you a perspective on is that our revenue has grown by more than 2 times in the last 2 years. In spite of the massive revenue growth, our EBITDA has grown by more than 3.5 times. So it is going to be very imminent in the near future.
Imminent in the near future, okay.
Where the company is
So 15% margin sustainable, or can you expand on it?
So it has been expanding over the last 2 years. I can't comment on the future numbers, but if you look at our trajectory in the last 3 years, we've significantly expanded 4x our adjusted EBITDA to get to that 177 crore mark. And we've grown significantly in this time, both in terms of square footage. We were at about 6 million square foot at that point of time back in 2022. We've grown to almost more than 10 million square foot today in 2 years. So our base has increased, our revenues have almost doubled, and our EBITDA margins have increased by 3.5 times.
Okay. And this revenue CAGR, I think I can calculate it close to 40%, 38, 39%. Is that the run rate? Do you think that's possible going ahead as you continue to scale and add capacity?
See, India definitely has the opportunity right now. If you look at the market, the flex space market in India was significantly small back in 2016 when we started this business. In a short span, it's grown to almost 80 million square foot of space across the country. If you look at CBRE's report, they've projected this number to go up to 145 million square foot. So the base of the industry itself is growing significantly. India is actually becoming a large flex market. It is one of the largest flex markets in APAC region today. So you will definitely see the market evolve further, but we can comment on the last 3 years where we've seen a significant jump, as you rightly mentioned, almost 40%, on a CAGR basis.
And today, I think you've got 10 million plus square feet in terms of what you're operating.
Yes.
How will the number change? I mean, what are your ambitions 2 to 3 years down the line? And even geographically, would you be looking to expand into tier 2 cities or go deeper in Singapore or add any other international markets?
So our strategy is obviously to keep growing the base. We have been able to grow at a certain pace in the last 2 years, which is 1.5 times that of the industry. Industry has only grown at about 23, 24%, while we've grown at almost 1.5 times of that at about 38%.
And of that 147 million square feet of space which is going to come up, how much do you think your share would be? From 10 million, where do you go?
So I think I can't comment on the future numbers, but what we can say is that we have grown faster than the industry.
1.5 times.
Again, 1.5 times faster than the industry. It is because of our model choice of what Smartworks really does. We have created a true platform. Smartworks today is India's largest managed campus platform. We take up buildings from non-institutional landlords. We don't take a floor or a part of a building. We take mostly full buildings. We convert them into large campuses with all the amenities that today's day and age employee requires. So we'll have outdoor and indoor gaming zones. We'll have multiple, we'll have gyms, creches, cafeterias, collaboration zones, medical rooms, all of this designed within our common spaces of the building before custom designing, building and maintaining the space for our large enterprise clients. Our focus is on mid to large enterprise clients. Almost 90%, 88 to 88% of our revenue comes from enterprise clients who are committing to more than 300 seats. 65% of our revenue comes from clients who are committing to more than 300 seats. If you look at that, our ability to take up such large buildings, which is unique, we take up on an average about 180,000 square foot of building, which is significantly higher than the industry average. We give it out to large enterprises who are looking. On an average, about 65% of our revenue comes from clients who are taking more than 300 seats. So they are taking that much.
Very quickly, so tell us, promoter holding is 65%. You all are selling partly in the offer for sale. What would that number come down to? And what are the plans? Are promoters going to stay long-term? I mean, are you long-term committed to the business? And even the big investor selling is Keppel Land. And they were early backers of yours. So what's the signaling there?
No, certainly. So Keppel Land has been a very long-term strategic investor in the company, and in fact, they've reinvested in the company as well. They, in fact, took a call to reduce their selling and reduced it by half.
Okay.
Taking cue from their longer-term orientation, we also reduced our OFS by half. So they will, after the IPO, continue holding about 15%.
From 19?
From 19. As promoters, we'll continue holding close to about 59%. And the relationship with Keppel is such that we last year acquired both of their co-working spaces in Singapore. And happy to share with you that today they are both profitable.
Who are some of the other big investors in the company?
So today we've got a very good set of marquee investors, which include high-quality family offices such as Ananta Capital, Hexaware, Jagdish Master from the Enam Group. We also have Deutsche Bank, who owns 1% stake in the company. And we do have angel investors. So Mr. Madhu Kela invested in through Mahima Stocks, which was back in 2017, and he has continued to reinvest in the company.
Okay, so that is Smartworks hitting Dalal Street on this Thursday. So do watch out for that one. We need to take a short break, but here is some good news for our viewers. India Business News Leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. Well, quiet for the markets. No real updates coming in. Wait and watch mode. So we need to get you some exclusive conversation. As we do that, we'll also wrap up on the show. It's an exclusive conversation where CII members don't want 26% additional US tariffs. That's the word coming in from the newly elected president of CII, Rajiv Memani. In conversation with Shireen Ban, he talks about trade deals with us, India-UK free trade agreement, and concerns around the rare earth magnet supplies. Listen in to excerpts of that conversation. We'll be back with Business Lunch.
You know, you were talking about the FTAs that India is inked. UK is done. EU is a work in progress. The US, anytime at least an interim deal, a mini deal is likely to be inked. So one, how is industry looking at it? You know, is there a feeling that there needs to be a harmonization of sorts across these various FTAs? Because I'll ask you this in the context of the EV manufacturing policy that the government has put out. Obviously, people are waiting to see what the FTAs will say before they actually go ahead with the EV manufacturing policy and apply it through that route. So what's the sense that you're getting from industry? Secondly, you know, let's bring up the EU FTA, for instance. European companies are sitting on large unutilized capacity. Will they use that, or will they choose to manufacture in India?
Yeah. So, I mean, let me first just the overall FTA. I think we must compliment the government, whether it's the Ministry of Commerce or other wings of the government. I think they've spent a lot of time, as compared to when the earlier FTAs were signed. They've spent a lot of time in engaging with each and every part of industry to understand what the issues are and where things stand. And I think that, I would say, their knowledge, the level of engagement that they have has been absolutely fantastic. Now, if you then take it to the second level, to say whether industry by industry, how does it pan out? I think, you know, FTAs are a negotiation. So I don't think every industry is going to be supremely happy about the FTAs. And in particular, I would say, and as far as EVs are concerned, I think the most important FTA, I mean, to be direct, is US. And I think I do hope that it gets signed on time, because if we talk to the members of CII, they don't want the 25% tariff to kick in on 8th of July or whenever. So it
might even be August now. We don't know.
So we don't need.
Don't know.
So I think they're keen that and it's also about relative competitiveness. Yeah. So, Vietnam signs something, if someone else signs something. So a lot of this is also about relative competitiveness. It's not just country to country, but it's also in the global order. And it reflects, when you sign an FTA, it also reflects to the industry that there is a level of confidence between the two governments where you're working together to increase trade between the two countries. So I think that strategically is very, very important. There is surplus capacity in some parts of the world, and there is a worry that if the duty rates are reduced, whether rather than manufacturing in India, those surplus capacity will be utilized outside. I think the government is well aware of this. I think industry has done, again, a lot of engagement. I think they've provided a lot of details.
Yeah.
in, what are the surplus capacities available, what has happened after FTAs and everything. And I'm sure in particular, when government is looking at negotiating the FTA with EU, they will bear this in mind. I think obviously India's interest is that, yes, these companies do come in, but they actually set up manufacturing bases in India, provide a better deal to the consumers, create greater value add in India for manufacturing. And I'm sure the government has the same in mind. So they will be focusing on getting that done. But as I would say, not every person would be, every industry would feel, that they had the best deal. And the second thing is that
the spirit industry clearly doesn't feel so.
The second thing is that, Shireen, that this, if you have a duty drop, depending on what the industry is, of 5% to 20%, I think where industry and government, and this is where what we are talking of in CII, where we have to work together is to try and see how does Indian industry become more competitive.
Right.
Which are the areas? Is it the customs duty on raw materials? It's the accumulation of GST that happens. It is energy costs. Can you provide easier open access? Can the Indian distribution structure be more efficient so that, the cross-subsidization reduces? Land, and can greater pools of land be available? Can we build a vendor ecosystem where the land that's being provided to them is at much more affordable cost? And also just the speed of doing business, the ease of doing business. And finally, in some cases, it may have to be supplemented with PLIs. So I don't think it's the end of the world. Once you have these kind of duty breaks, how India becomes more, because India is fundamentally, I do believe that the innovative spirit, the entrepreneurial spirit, the cost structures that we have in broad, and the way industry and government are engaging, I strongly feel that maybe in some industries it is a question of some time, but competitiveness is very inherent in most industries. I think where we don't have technology, where it's rare earth, where it's advanced manufacturing, I think those are more challenging.
Has there been any forward movement on the issue of rare earth, for instance? I mean, China and Europe have now managed, US and Europe have managed to get supplies started from China as far as rare earth is concerned. Any forward movement on that? Have you heard from the government, or whether there are talks underway, likely to be?
We haven't heard from the government, but I think India, as you probably would have read, I think in Quads there's been discussions around it to say what is happening. Various other countries like Japan in particular and others are engaging with Indian industry to try and see what can be done to supplement it. But it's a serious issue, especially for the auto industry, the EV industry. I think it's a serious issue, and it is something that will have an impact in the next few months in production and everything else.